central banks need to try to do what we can to make sure the liquidity side is handled. We don't have any, the solvency part, the Federal Reserve and the central banks in general don't have any scope. On the solvency side, I think we have been forced into the government broadly, but not in the United States. One of the points I was really trying to make today is that despite all the focus on what happened in the U.S., this was a global event and happened. Many of these interventions occurred throughout Europe, for example. That these interventions were necessary given the short-term alternatives, but it's very important that financial reform avoid the need for these kinds of interventions, except in the most extraordinary circumstances. So in particular, two ways to do that. To address the too big to fail problem, which is a huge problem. We have to deal with that problem. First, tougher oversight, which includes more capital, more control of risk, and so on, that reduces the risk of insolvency just on that side. But also, in the case where insolvency occurs, one of the key ideas, I think, of the proposed financial reforms is to have some kind of special resolution regime that would allow the government to wind down, much as it does now, banks, any systemically critical financial institution, in a way that would impose market discipline, impose losses on creditors, but would avoid the disorderly, chaotic type of collapse that we saw with Lehman a year ago. So we want to keep the government out of providing capital, and those are two ways to minimize the risk of that.